Welcome back to the program, ladies and gentlemen, dollars and cents. This is Joel Garris of Nelson Financial Planning. You're listening to a program that was recently named one of the top 25 financial planning podcasts on the World Wide Web. A couple of shows from Australia, one from Ireland actually made the list, and so too did little old dollars and cents here in Central Florida. So very excited about that. Go to our website to learn more about that accolade. Plus, if you'd like to subscribe to any one of our social media channels, you can do that by going to nelsonfinancialplanning.com. Upper right-hand corner, a bunch of icons. Click on one that looks most familiar to you, and instantaneously you become a subscriber, whether it's YouTube, Google, iTunes, whatever the case may be. We're there, and you can be as well. So, on this part of the program, we thought we would talk a little bit about should you pay off your mortgage or should you invest that money? Very traditional financial argument that you hear a lot about. An interesting new study and analysis was done on it. That study was actually something that was shared with us by a longtime client, and so it's the kind of thing that we like to talk about on the program because there's a variety of ways in which to look at this puzzle. And certainly the analysis that was done had some interesting conclusions. So what the analysis did is it looked at sort of rolling 40-year, 43-year periods of time back to like 1971. And it looked at the S&P 500, the rolling return of the S&P 500 over a 5-year period of time. It also looked at the rolling performance of the S&P 500, which is a performance measure of the 500 largest companies in America, generally thought of as sort of the bellwether, if you will, for the overall market, hence because it has 500 different companies in there. So it looked at 5-year rolling numbers, meaning the performance over a 5-year period of time, and then 10-year rolling numbers, and then compared that to the average mortgage rate set forth by Freddie Mac during that same period of time. And what was fascinating on it is that it really comes down to, as do most things when you're trying to pick between different ways to invest, there's an economic term called opportunity cost that summarizes exactly what the difference is. If I invest money this way, then I'm not able to invest it this other way. And so what's the difference? That difference is typically described as your opportunity cost. And so that opportunity cost really comes down to your investment horizon and your tax situation. Interestingly, when it looked at the performance of the S&P 500 and adjusted that for taxes, because obviously you have to pay taxes on dividends, capital gains, things like that, and then also adjusted the results of paying the mortgage for the tax savings. What was interesting about that is that paying off the mortgage or investing the money wins about 53% of the time. Well, 53% of the time. And some of the other numbers that they ran, it was like 60% of the time this one wins, 60% of the time that one wins. What was interesting about the entire analysis is just how close it really was. There was certainly no definite winner, do this versus do that, depending upon the period of time. It was very close in terms of which one ultimately came out. More often than not, paying off the mortgage and investing the money was very close. If you take out the tax benefits, then maybe you get a little bit ahead by investing the money about 60% of the time. The reality is, though, that there are certainly some other things to consider, particularly in retirement. So it really boils down to, if you've got money, to be able to invest it or to pay down the mortgage, I think you really need to be thinking about it in terms of where it will really matter, and that is that cash flow issue will become paramount when you get to retirement. Because obviously, if you still have a mortgage, then you've got a major burn of cash flow during the course of retirement. So one of the things that we always say to people is make sure that your mortgage is paid off when you get to retirement, because you're going to need that additional cash flow for one of two things. One, which is something that nobody really likes, but it exists, particularly when you're retired, and that is paying for your health care. Big cost. More often than not, if you're working, your employer pays for it or pays for a large chunk of it. When you retire, then now you've got to pay for it all on your own. And then number two, something that we like to refer to as free time expense, right? If you're retired, you got free time. If you have free time, generally you're not just sitting on the couch. You're out there doing things, and guess what? You're out there doing things, and that costs money. Versus when you were working, you just went to work, and you weren't taking time off to golf or to hop in the RV or to travel or whatever the case may be. All of those activities take money, and that is a new expense that you have in retirement. So typically our suggestion is to make sure that you have that mortgage paid off, or you certainly have it as part of the cash flow. It really boils down to, if I've got cash, what's the best thing to do with it? And if you have your mortgage structured so that it is fully paid off in retirement, then that obviously is the best case scenario. Now, some things to consider in that analysis. First of all, if you've got higher interest rate debt that's outstanding, obviously the dollars need to go to that before they can go to the mortgage. There's also something to consider there in terms of your kind of your risk profile. Paying down a mortgage obviously gives you a guaranteed return that ultimately you're avoiding the cost, maybe 3, 4, 5%, depending upon what your mortgage interest rate is. You're ultimately avoiding that cost, that drag on your cash flow. And so consequently, you sort of get almost like that rate of return by ultimately eliminating the mortgage. So be mindful of the cash flow. Make sure that you are fully connected to the amount of money that you need to put on your mortgage to make sure that it is fully paid off. But certainly an interesting analysis. At the end of the day, no real clear, decisive victory for either pattern, paying off your mortgage versus investing the money. So certainly it's a toss-up. I think the best way to approach that toss-up is you certainly want to be investing money on a regular basis, but you also want to make sure that over time, the payments that you're making on your mortgage will effectively eliminate that mortgage by the time you get to retirement. I think that's the proper balance to strike. I'm not a particularly big fan of, if I get a large chunk of money, maybe I inherited, maybe whatever the case may be, I get a bonus, whatever the case may be. I'm not a particularly big fan of taking all of that and immediately trying to pay down on the mortgage with that. I would rather see a mortgage paid off over time using cash flow rather than the first time you get a chunk of money, it sort of disappears into the mortgage. So the one caveat to that would be chunks of money, I think, are better served getting invested because that gives them a longer time frame in which to invest. It also, let's face it, an investment is always going to be more liquid than a house, right? I mean, you can take money out of the investment to go on a trip. Can't really take money out of the house to go on a trip. I suppose you could if you were doing a home equity line, but why would you do that in retirement? Because now you've got a debt that the whole point of is to not have a debt in retirement. So remember the liquidity aspect of it as well. So I think in the case of where I get a chunk of money, I would rather see that invested, particularly since this analysis grants it a little bit of a toss-up. And then the goal is pay the mortgage off over time. It's very easy. There's a bunch of amortization calculators, things like that out there on the web that you can plug in the numbers and figure out, okay, if I just add $250 or $350 more per month to my mortgage payment, it's paid off in X years, and make sure that X years is when you plan to retire. One other comment on the tax side of things, the tax benefit of a mortgage, which again is why this analysis winds up being much closer. The tax benefit of a mortgage interest deduction is not as valuable as it used to be. In today's world, with the higher standard deduction, approximately 82% of homeowners that have a mortgage will wind up not being able to write off that mortgage interest because the new standard deduction is so high. For those that do, though, it makes a lot of sense to have that mortgage interest, because for the vast majority of homeowners that are writing off mortgage interest, what the analysis is that those people find themselves in the 24% income tax bracket or higher. So the higher your income, the more the justification is to have that mortgage interest and to have that mortgage interest deduction. So some interesting ways to kind of look at it. Interestingly, the study concluded that there wasn't really a clear, significant winner to the process. It was sort of a toss-up, if you will. And so in our minds, that means, well, then if it's a toss-up, then you probably should be doing both things and do both things along the way as you approach retirement. But bottom line is to not have that cash flow item in retirement, so make sure that you time the payoff with when you plan to retire. So some interesting numbers on that we wanted to share. We're going to take a break. When we get back, we will continue the conversation. It's tax time, so we'll talk a little bit about the difference between credits versus deductions, which one is more important for you. Plus, we'll also fill you in a little bit more on the details that the IRS has put forward in terms of being able to reduce your rental income profit. All that and more on the program. This is Joel Garris of Nelson Financial Planning. Dollars and Cents on News Radio WFLA Orlando.